Welcome to my channel. If you're an investor or considering getting into the stock market, you've probably wondered, when is the best time to sell my stocks? Knowing when to sell can be just as important as knowing when to buy. In today's video, we're diving deep into this critical topic, helping you understand the key factors you need to consider before deciding to sell your stocks. Whether you're a beginner or an experienced investor, this guide will provide you with valuable insights to help you make informed decisions. Remember, this is not financial advice. Segment 1. Understanding your investment goals. The first step in determining when to sell your stocks is to understand your investment goals. Why did you buy these stocks in the first place? Your reasons for investing will significantly influence your decision to sell. Let's break this down into a few common categories. Short-term goals. If your goal is to achieve short-term gains, perhaps within a year or less, then your strategy will focus on capitalizing on market volatility. You may have bought stocks at a low price, anticipating a quick rise. For short-term investors, timing the market becomes more crucial because they're looking to profit from rapid price changes. For instance, say you bought a tech stock because you expected the company to launch a groundbreaking new product. The stock's price surged after the launch, and now you're sitting on a 30% profit. The question is, do you sell now and lock in that profit, or do you hold on, hoping the price will rise even higher? The answer depends on your risk tolerance and how quickly you need the money. If the stock has reached or exceeded your target price, selling might be the right move. However, if you believe there's more upside potential, you might choose to hold, keeping an eye on any signs that the momentum is slowing. Long-term goals. On the other hand, if your goals are long-term, such as saving for retirement or your child's college education, your approach will be different. Long-term investors typically aim to hold stocks for several years, if not decades. The idea is to ride out short-term market fluctuations and benefit from the overall growth of the company and the market over time. For long-term investors, selling should align with achieving your financial milestones or when the underlying fundamentals of the company no longer support holding the stock. For example, if you're investing in a solid blue-chip company with a history of steady growth and reliable dividends, you might choose to hold your shares through market ups and downs. You're less concerned with short-term price drops because you're confident in the company's long-term prospects. However, even long-term investors need to consider selling if the company's fundamentals change significantly. Suppose the company you've invested in suddenly starts losing market share to competitors, or its business model becomes outdated due to technological advancements. In that case, it might be time to reassess whether holding the stock still aligns with your long-term goals. Income goals. Some investors focus on generating income through dividends rather than capital gains. If your goal is to build a portfolio that provides a steady income stream, you'll likely hold on to dividend-paying stocks as long as they continue to meet your income needs. You might consider selling if the company cuts its dividend or if you find another investment offering a higher yield without significantly increasing your risk. Rebalancing your portfolio. Another reason to sell might be to rebalance your portfolio. Over time, certain stocks or sectors may outperform others, leading to an imbalance in your asset allocation. If one stock has grown to occupy a larger percentage of your portfolio than you're comfortable with, it might be time to sell some of those shares and redistribute the proceeds into other investments to maintain your desired level of diversification. Before we continue, remember to like the video and subscribe to the channel. Segment 2. Analyzing market conditions. Next, let's talk about market conditions. Many investors try to time the market to maximize their returns, but this can be challenging. However, understanding the broader market environment can help you make more informed decisions about when to sell. Bull market. A bull market is characterized by rising stock prices, often driven by strong economic indicators such as high employment, rising GDP, and positive corporate earnings reports. In a bull market, it might seem counterintuitive to sell, especially when everyone is talking about how much money they're making. However, selling in a bull market can be wise if you believe the stock has become overvalued. For example, suppose you bought shares of a company that has seen its stock price double over the past year due to strong market sentiment. You might decide to sell some or all of your shares if you believe the stock price has risen beyond the company's intrinsic value and that a market correction is likely. Another strategy could be to sell a portion of your holdings to lock in some gains while letting the rest of your investment continue to grow. However, be cautious of selling too soon during a bull market. Many investors fall into the trap of selling their winning stocks too early, missing out on further gains. It's essential to balance the desire to secure profits with the potential for continued growth. Bear market. A bear market, characterized by falling stock prices, can be a stressful time for investors. In a bear market, the overall sentiment is pessimistic, and stocks often decline in value across the board. Selling during a bear market might seem like the right move to avoid further losses, but it's essential to consider the long-term prospects of your investments. If you have strong convictions about the companies you've invested in and believe they have solid fundamentals, it might be better to hold onto your stocks rather than selling at a loss. In fact, some investors view bear markets as opportunities to buy high-quality stocks at discounted prices. However, if the bear market is prolonged, and you notice that the company's fundamentals are deteriorating or that industry conditions are worsening, selling might be the best option to prevent further losses. Market timing versus time in the market. It's also important to discuss the concept of market timing versus time in the market. Market timing involves trying to predict the best times to buy and sell stocks based on market conditions. While some investors and traders are successful at this, it's incredibly difficult to consistently time the market. Even professional investors often struggle with market timing, as it requires accurately predicting not just when to get in and out of the market but also when to reinvest. On the other hand, time in the market refers to the strategy of staying invested for the long term, regardless of short-term market fluctuations. Historical data shows that the stock market tends to rise over the long term, despite short-term volatility. For many investors, particularly those with a long-term investment horizon, staying invested and riding out the ups and downs can lead to better outcomes than trying to time the market. In summary, while analyzing market conditions can provide valuable insights, it's essential to avoid making knee-jerk decisions based solely on short-term market movements. Instead, focus on the fundamentals of the companies you're invested in and how they align with your investment goals. Segment 3. Evaluating company fundamentals. Now that we've discussed your investment goals and market conditions, let's delve into the importance of company fundamentals. Evaluating the financial health and overall outlook of the company is crucial in determining when to sell a stock. Declining revenues or profits. One of the most significant red flags to watch for is declining revenues or profits. A company's ability to generate consistent or growing revenue is a key indicator of its financial health. If you notice that a company's revenues have been declining over several quarters or years, it's worth investigating why this is happening. For instance, if a company has been losing market share to competitors or its products are becoming obsolete, its revenue might start to decline. Similarly, if profit margins are shrinking, it could indicate rising costs, decreased pricing power, or inefficient operations. While a single quarter of weak performance isn't necessarily a cause for alarm, a consistent trend of declining revenues or profits could be a sign that it's time to sell. Changes in management. Another critical factor to consider is changes in management. The leadership team plays a vital role in a company's success. A change in the CEO, CFO, or other key executives can significantly impact a company's strategic direction and performance. If the new management team has a track record of poor performance or if their vision for the company doesn't align with your investment thesis, it might be a good time to consider selling. On the other hand, a change in management could be positive if the previous leadership was ineffective. It's essential to evaluate the new team's plans and track record before deciding whether to sell or hold onto your shares. Industry trends and competitive position. The broader industry trends and the company's position within its industry are also crucial factors. Is the industry growing or shrinking? Is the company a leader in its field, or is it losing ground to competitors? For example, suppose you've invested in a company within the retail industry. Over the past few years, online shopping has grown significantly, while brick-and-mortar stores have struggled. If the company you're invested in hasn't adapted to this trend and continues to rely heavily on physical stores, it might be time to reassess your investment. Similarly, consider how the company is positioned relative to its competitors. If competitors are consistently outperforming the company in terms of innovation, customer satisfaction, or market share, it could indicate that the company's competitive advantage is eroding. In such cases, selling might be the right decision before the situation worsens. Product or service obsolescence. Another factor to consider is whether the company's products or services are becoming obsolete. Technological advancements can quickly render products or business models outdated. For example, companies that failed to adapt to the shift from physical media to digital streaming services saw their market share and revenues decline rapidly. If you notice that the company's products are becoming less relevant in the market, or if new technologies are emerging that could disrupt the company's business model, it might be time to sell before the company's value declines further. Debt levels and financial stability. Finally, consider the company's debt levels and overall financial stability. High levels of debt can be a warning sign, especially if the company struggles to generate enough cash flow to meet its debt obligations. Rising interest rates or a downturn in the company's business can exacerbate these issues, potentially leading to financial distress or even bankruptcy. If a company's debt levels are increasing while its revenues and profits are declining, it might be wise to sell your shares before the situation deteriorates further. Conversely, companies with strong balance sheets, low debt levels, and ample cash reserves are generally better positioned to weather economic downturns and other challenges. Segment 4. Tax implications and costs. Selling stocks is not just about market conditions and company performance. It's also important to consider the tax implications and costs associated with selling. Capital gains tax. When you sell a stock for a profit, you're generally required to pay capital gains tax on the profit. The amount of tax you'll owe depends on how long you held the stock and your tax bracket. In many countries, capital gains are classified as either short-term or long-term. Short-term capital gains are profits from selling stocks you've held for less than a year. These gains are typically taxed at your ordinary income tax rate, which can be higher than the rate for long-term gains. On the other hand, long-term capital gains, which apply to stocks held for more than a year, are usually taxed at a lower rate. For example, in the United States, the long-term capital gains tax rate ranges from 0% to 20%, depending on your income level, while short-term gains are taxed at rates ranging from 10% to 37%. Therefore, if you're close to reaching the one-year mark on a stock you're considering selling, it might be worth waiting to qualify for the lower long-term capital gains tax rate. It's also worth noting that tax loss harvesting can be a strategy to reduce your tax liability. If you have other investments that are currently at a loss, you can sell those investments to offset the gains from your profitable stocks, thereby reducing your overall capital gains tax. However, be aware of the wash sale rule, which prevents you from claiming a tax loss if you repurchase the same or a substantially identical security within 30 days before or after the sale. Transaction fees. Another cost to consider is the transaction fees associated with selling stocks. These fees can include brokerage commissions and any other costs your broker may charge. While many online brokers have reduced or eliminated trading commissions, it's essential to be aware of any fees that might apply to your specific account or investment. Additionally, if you're selling international stocks or stocks on foreign exchanges, you might incur currency conversion fees or other costs related to foreign transactions. These fees can eat into your profits, so it's important to factor them into your decision to sell. Segment 5. Emotional decision-making. Investing is not just a financial decision, it's an emotional one as well. Human emotions like fear, greed, and the desire to follow the crowd can significantly impact investment decisions. Let's explore how to manage these emotions when deciding whether to sell your stocks. Fear of missing out, FOMO. One of the most common emotions in investing is the fear of missing out, or FOMO. When you see everyone else making money in a booming stock or market, it's easy to feel pressure to jump in or stay invested, even if it goes against your strategy. FOMO can lead to selling too soon, just to lock in a profit before everyone else does, or holding onto a stock far longer than you should, hoping for even bigger gains. For example, during the dot-com bubble of the late 1990s, many investors held on to tech stocks for too long, driven by the fear of missing out on future gains. When the bubble burst, those who didn't sell in time faced significant losses. The key to avoiding FOMO is to stick to your investment plan and maintain discipline. Set clear target prices for when you plan to sell, and don't let the excitement of the market cause you to deviate from your strategy. Remember, the stock market will always present new opportunities, so there's no need to chase every trend. Loss aversion. Loss aversion is another powerful emotion that can influence investment decisions. Studies have shown that the pain of losing money is psychologically more intense than the pleasure of gaining it. This can lead to investors holding on to losing stocks for too long, hoping they'll rebound, rather than selling and accepting the loss. For example, if you bought a stock at $100, and it's now trading at $70, you might be reluctant to sell because it would mean realizing a $30 loss. However, if the stock's fundamentals have deteriorated and there's little chance of recovery, holding onto it in hopes of recouping your losses might result in even greater losses over time. To combat loss aversion, focus on the future potential of the stock rather than its past performance. Ask yourself whether you would still buy the stock at its current price if you didn't already own it. If the answer is no, it might be time to sell and reallocate your capital to a more promising investment. Overconfidence. Overconfidence is another common pitfall for investors. It can lead to the belief that you can consistently predict market movements or that your stock-picking abilities are better than they actually are. Overconfidence can cause you to hold on to stocks even when the data suggests it's time to sell. For instance, you might have had a few successful investments in the past, leading you to believe you can time the market perfectly. This overconfidence can cause you to ignore warning signs or dismiss negative news about a company you're invested in, potentially leading to significant losses. To avoid the pitfalls of overconfidence, rely on data and analysis rather than gut feelings or past successes. Regularly review your portfolio and be open to reevaluating your decisions based on new information. Following the crowd. Finally, the herd mentality can also influence when you decide to sell. It's natural to feel a sense of security in numbers, but following the crowd can lead to poor investment decisions. If everyone is selling, you might feel compelled to sell as well, even if there's no solid reason to do so. Conversely, if everyone is holding onto a stock, you might hesitate to sell, fearing you'll miss out on further gains. A classic example of herd mentality was the housing bubble of the mid-2000s. As housing prices soared, more and more people invested in real estate, believing prices would continue to rise indefinitely. When the bubble burst, many investors were left with properties worth far less than they had paid, all because they followed the crowd instead of doing their own analysis. To avoid the dangers of herd mentality, base your decisions on your own research and analysis. Just because others are buying or selling doesn't mean it's the right move for your portfolio. Conclusion. Deciding when to sell a stock is a critical aspect of successful investing. By understanding your investment goals, analyzing market conditions, evaluating company fundamentals, considering tax implications, and managing your emotions, you can make more informed and rational decisions. Remember, there's no one-size-fits-all answer to when to sell, as every investor's situation and strategy are unique. The key is to remain disciplined, stick to your investment plan, and be willing to adjust your strategy as new information becomes available. By doing so, you can maximize your returns and minimize your risks over the long term. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investing tips and strategies. Let us know in the comments your thoughts on when to sell stocks, and if there's any other topic you'd like us to cover.